Good morning and welcome to this Wednesday, August 3rd, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know to prepare anyway, for the trading day ahead. We'll see what happens as the day goes on, but futures at least looking pretty decent this morning. The runs continued, although we've kind of flattened out the last couple of days. We saw the Dow actually take it on the chin. We'll go over that in a little bit, but the Dow was a little rough yesterday. NASDAQ actually finished fairly close to break even, but our major indices were lower yesterday. However, this morning things appear to be looking a little bit better, at least at the open. We got the Dow Jones Industrial Average, or at least the diamonds, projected to open up about a little more than 0.5%. So getting back some of what was lost yesterday. The Spider, which tracks the S&P 500, set to open up about 0.6%. And then the QQQ, which tracks the NASDAQ 100, about 0.65%. So the NASDAQ showing a little bit of relative strength, but all three of those key indices do look ready to open higher today. So that is at least one positive as we get this hump day started. Historically, for those of you that don't know, Monday and Tuesday, not very good action historically on the S&P 500. This dates back to 1950, but Wednesday through Friday, the strongest days of the week. So I don't know if that matters or not. I think it matters on a, over time. Over time, it's told us that it matters, and it showed us that it matters. But whether or not that matters today, I guess we'll find out. Anyway, I always like to throw in those historical facts. I think they're pretty amazing, especially when you consider, Monday and Tuesday combined are down on the S&P 500 since 1950. That's amazing to me. It's 2/5 of the week. But Wednesday, Thursday, Friday, over the last 72 years, that's where all the gains on a net basis have come on the S&P 500. And I think it's even more so on the NASDAQ. So always nice to get into the Wednesday action, get things going for the second half of the week. All right, before we get into anything, let's take a look at, I'll take you over to EarningsBeats. For those of you who are new, this is the best way to get to know us. Obviously, watching the shows, reading my blogs over at Stock Charts, but then I also have a 3 times a week newsletter here at EarningsBeats. It's free. So if you go over to EarningsBeats.com and then simply scroll down, you will find an area where you can sign up for our EarningsBeats Digest. All it takes is a name and an email address. Hit that subscribe button. There's no credit card required. You can unsubscribe at any time. 3 times a week, as I mentioned, Mondays, Wednesdays, Fridays. So this morning, already sent one out. Actually, yeah, probably out by now, should be out by now. But that was on a software company coming up for earnings. I think they're going to report either, I don't know if it's Thursday, it's probably Thursday evening, could be Friday morning, but I know Friday morning at 9:30, that's when we'll get the reaction to their earnings report. But anyhow, there's a software company. I think, this is one of the better looking charts heading into earnings. I would think they're going to have a really good report. But that was the topic of this morning's discussion in the Digest newsletter. Anyhow, if you sign up, again, no credit card required. You can unsubscribe at any time. No questions asked. Love to have you. I think these setups sometimes is great trades if you so choose. Other times, just very educational in nature. Try to be anyway. So I think you'll enjoy it. Moving on to the action from Tuesday, we had the Dow Jones Industrial Average down 402 points, down 1.2%. S&P was down 27, so on a percentage basis, about half that, about 2/3 of 1%. The NASDAQ was down 20 points, which was just a little less than 0.2 of 1%. The mid caps, I just looked down and saw that I've got the rate of change in MACD on here. I don't know if you were watching the show yesterday over at Stock Charts, but I showed how you could set up candle glance. And of course, I forgot to change it back. So I'm just kind of chuckling here. Anyway, the NASDAQ finished down 20 points yesterday. Mid caps down 24. That was close to 1%. Small caps down 10 points, which was about 0.8 of 1%. Moving on to the sectors. Real estate. First of all, one thing I thought was very interesting. NASDAQ was only down 0.16%. S&P was down, okay, 2/3 of 1%. Still not bad relative to what we've been doing. This is an hourly chart, by the way. That's why, we haven't been, if you're used to seeing this as, long-term daily chart, we've had a good run, but it hasn't quite been this good, not over, 6 months. This is just going back the last couple of weeks, 2-3 weeks. But the one thing I found interesting when I looked at the sectors, and I didn't even realize it until this morning when I looked, all 11 sectors were down. I would not have thought that with the NASDAQ being down 20 points. But all were down. And so worst sectors, and the reason why the overall market didn't get hit that hard was that as you look across here, none of these sectors have massive weightings in the S&P 500. So these were the worst performers yesterday. Real estate down 1.3%, financials 1.1%, industrials 1.05%, materials down 1.02%, and staples down 0.8%. But notice what's not on this list here of the 5 worst. We don't see technology here. We don't see consumer discretionary here. We don't see communication services. So those 3 really aggressive groups held up on a relative basis really well yesterday. So if you want to, if there's one silver lining to the weakness yesterday, it was that it wasn't being led by some of those aggressive groups. So short term, I would say that's probably a pretty good indication. Down here at the bottom, by the way, if you didn't tune into the show yesterday, when I set up this rate of change down on the bottom of this candle glance chart, this 32 period, remember, this is an hourly chart. So 32 periods is essentially 1 week. So it's a 1 week rate of change because the stock market opens 9:30 Eastern, closes 4 o'clock Eastern. That's 6.5 hours. 6 times 5 is 30, and then 5 times a half, 2.5. So you got 32.5 hours. So roughly 32 is going to give us a 1 week rate of change. So if maybe that's something that's kind of neat, a little unique. We don't really look at it like that. But if you look across here, the Dow over the last week up 1.49%, the S&P 2.84%, and the NASDAQ 4.10%. So at least over the last week, this is the configuration you really want to see in a bull market or the resumption of a bull market. You want to see the money rotating into the more aggressive areas of the market. Mid caps up 3%, small caps 2.8% over the last week. Anyway, thought that was kind of interesting, but I knew I was going to forget to change the candle glance. I'll probably have this going on for about 30 days now before I'll remember to change it, but I'll try to get it before the show tomorrow. All right, 10-year Treasury yield. Let's get an update, get the latest. Big rise yesterday in the yield. I think that may have spooked the market a little bit. If we pull it up on a 5-day, 10-minute chart, we were down 2.53%, actually 2.52%, I think, at one point early yesterday morning on the yield. Came all the way back up to close at 274. That is a lot of movement up in the yield, which means there was a lot of selling of bonds yesterday. And it could be just some profit taking. There's been a lot of folks been buying bonds. I mean, the yield's been coming down for quite a while now. Go back to that daily chart. So you can see yield's been coming down. That means prices have been going up. It's always that inverse correlation, always, 100%. So when you see the yield going down, it means prices are going up. When the yield bounces like that, that means prices are going down. So we're seeing some profit taking. Folks that have bought bonds over the last 6-7 weeks had some nice profits. They started to book it. We saw that once before back here at the beginning of July before we rolled over again. So it's no different than the stock market where you have, stocks that go up and then you have periods of profit taking. You do the same thing as in the bond market. Anyway, there's the recovery yesterday where we are up off of that today, 2.785. And, I said recently that first test for, at least on the yield, first test is going to be that 20-day moving average, which is now declining. It's below the 50. This is the setup for a downtrend when you have price action, or in this case, yield below the 20-day, which is below the 50-day, and you got the PPO in negative territory. This is how downtrends look. So the first thing you want to do if you want the yields back up, if you really think inflation's a problem, you should see this yield really taking back off, especially as we get closer and closer to the the big inflation reports. So we'll have the CPI and the PPI coming out. I didn't look, but probably next week, I would think. Middle to the end of next week would be my guess. Usually it's out around the 10th, 12th, 15th, something like that. So that's what I would be looking for here. See if we hold this resistance, which right now is at 2.84%. As long as we hold there and roll back over, I would continue to consider this a downtrend. If we get through that 284 level, then we're talking maybe more about perhaps sideways consolidation. Anytime I see moves through the short-term moving average, I start thinking consolidation. Now, if it comes back down, hits it and supports it, and then breaks to a new high, then we could be looking at downtrend turning into an uptrend. But I don't want to get too far ahead of myself. Let's watch that 20-day moving average, see what happens there. In terms of economic reports, June factory orders came out they come out later this morning. The expectation is for the factory orders for June to rise 1.1%. May was up 1.6%. So we're still looking for some pretty hot activity in the factories, but maybe not quite as hot as we saw in May. So things slowing down, which kind of coincides with, I think, what everybody's probably been feeling about the economy lately. All right. Move on to the S&P 500, talking technically. So I was looking at the S&P and talking to members yesterday and the last couple of days, we're getting to a point where I think, we could just go straight up. This could be a V bottom. We just keep going higher. That's probably not the most likely, but if you look back at some of these bear market bottoms, some of them have been straight up. You come out of the bottom and you really don't do a whole lot of sideways movement. You don't lose the 20-day moving average very often, at least for the first few months coming out of the bottom. So my gut tells me we're probably going up to test this high, which is what I've been saying for a while. That was around 4180 or so. So I wouldn't be surprised to see us get there and maybe even to 4200. But if you look, there was a lot of resistance. Here's a resistance at support at 4300, support at 4300, support above 4100, support in the 4200s, support in the 4200s, and then we fell. So if you're looking at it like that, you got to figure 4200, 4300 in that range is probably going to present a lot of overhead resistance. And so don't be surprised if we get up in here and we churn a little bit. Now, before we get up in there and churn, maybe we get up there and have one pullback. And the reason I say that is the 60-minute or 1 hour chart, the divergence here is pretty negative. So you can see the S&P going sideways here, but this consolidation has brought this, the hourly PPO down. So if we move back up and set a new price high, chances are we're going to have a negative divergence on this hourly chart. Now I'm going to stretch this out a little bit. We'll go back to the beginning of the year. We haven't had many negative divergences set up because we haven't been trending higher long enough. Everything's been to the downside. I mean, here you can see a beautiful positive divergence. Right when I called the bottom, June 17th, you see that low right there? Look at the PPO on the hourly chart. That was another nice little signal that, perhaps we were at least going to turn higher for the near term. Here we rise, pull back, rise, little head fake right here, breaking below these lows, but that was quickly eliminated and back to the upside we go. But now look at where we are. So here's that move up, got to almost 4150. These highs came in at about 4180. So I'm thinking we could maybe make one more push to the upside. But if we do, we're going to be looking very similar to what we did here. You see how we made this one push? We'd gone down just below the 20-day, and we made this one final push up here. And look at where the PPO was. It looks almost identical right now. Now, I'm not saying that means we have to turn, but if we do go up, we have a negative divergence, which is just one more indication that momentum is slowing and we could just use a pullback. Now, the last time we did this, I don't expect that, but I wouldn't be surprised if we pulled back maybe to this 50-hour, maybe even down closer to 4,000. I think that's going to be a psychological support level going forward. So if we get back up to 4180, 4200, Personally, for me, I'll be taking less risk. I already am taking less risk. But that's because, maybe we don't get up to 4,200. We've had a big run, profit taking. I mean, all of those things have factored in for me. I just want to make sure that, I capture profits coming off of this low from back in mid-June. But I'm looking at 4,180, 4,200 kind of as a short-term area where maybe we get a head fake, one last head fake to the upside, and then maybe pull back 4 or 5%. Reset everything, kind of recalibrate, and then hopefully be poised for another run to the upside. I want to talk a little bit about software. I wrote about it over the weekend. I'll show you this seasonality chart. Software, and if you set up seasonality, first of all, when you go in here in the drop-down menu, just click on seasonality, put in whatever it is you want to look at. Here I typed in $DJUSSW, which is software, and this is what will come up. This is the default last five years, and this is how it's performed. Now, one thing I want to look at just over the last 5 years, and again, I put in the SPX, so it's telling me how software has performed relative to the S&P 500. So software may have gone up all 5 years, but it's showing in August, but here it's only showing 80%. So it may have gone up for the last 5 years, but one of those years, it would have underperformed the S&P 500. So in that case, it's outperformed the S&P 4 out of the last 5 years, which is 80%. Down here at the bottom, this is the average percent or the average outperformance in percentage terms. So when you look at this over the last 5 years, June has been the best month for software over the last 5 years. It's been averaging, beating the S&P 500 by 3.1% over that 5-year period. August, though, is the second best over the last 5 years, if you look down here at the bottom. And if I stretch this back to 10 years, and I like 10 years because it goes back to 2013. And if you recall, 2013 is where the S&P 500 broke above that 1560 area. That was the top back in 2007, 2000. So when we broke out in April of 2013, in my opinion, that's when we started. That's when we confirmed that we were starting the new secular bull market. A lot of folks say 2009, but 2009 was no different than 2003, or maybe it wasn't going to be any different. Remember, 2003, we bottomed and we went up for the next 3 or 4 years, but we never went above the 2000 high and we went right back down. Nobody talks about 2003 being the low or the bull market low or the start of this bull market. Why? Because it never broke out and ended up going right back down. In 2009, we didn't know what was going to happen. So anyway, 2009, we go back up. And then in 2013, we made the breakout, April 10th, 2013, if you want the date. Anyhow, since then, so this is the last 10 years going back through 2013. So during this secular bull market, you can see 8 out of 10 years, software's outperformed the S&P 500 in August. Same with July. But look at the average outperformance. 2.1% average outperformance. October is the only other month that's close. The average outperformance there is 2%. Adding the two together with a little bit of weakness in September in between, this is the strongest 3-month period for software relative to the S&P 500 coming up August, September, October, those 3 months. So it probably makes sense for us to at least be looking at software. And so I wrote another article yesterday in my Trading Places blog. And again, just trying to highlight for those who just read my information, publicly, all the free information, but I wanted to show some of the things you can do with our products and services at EarningsBeats if you're a paid member. So this is actually, this one you can do even without being a paid member. This is actually in our EarningsBeats digest. You can get a link to download these upcoming earnings chart lists. But one thing I'm doing right now each day is I'm looking at the software stocks that are going to be reporting earnings. So these are all companies that reported. I think EVOP, even though Zacks provided this date, I think they already reported. I think they reported 2 days ago. I remember seeing a big move up on that company. after they reported. So I think they just came out early. Anyhow, these others are all just reported either yesterday after the close or this morning. I think probably all of them or most of them were after the close yesterday. But when the market opens today in 10 minutes, what you can do, you can sort this all kinds of different ways. You can, once the market opens, best way to, what I do usually about 9:32, 9:35 every morning is I go into this chart list and I see, okay, what's reacted positively. And I really like to see what's reacted negatively to earnings, because some of these companies had big run-ups. They got really strong ADs. Their relative strength is awesome. They report good results, and then the stock market sells off. One that I gave our members not too long ago was MedPath. Remember that one? If you remember, MEDP. I want you to look at this chart. Here was earnings. Look what happened intraday. And I wrote about this at about 10:45 in the morning. I think MedPath was around 148. And essentially I said, listen, here's a company that beat top line, beat bottom line. I mean, I thought the numbers were pretty strong, and the stock had already been moving higher. I think you can see, look at the AD line. AD line, very, very strong. I think relative strength had begun to pick up. Yeah, I mean, here heading into earnings, we were at what, about a 5-month relative high versus biotech space. So it was really looking good. And then the earnings came out, and hey, I can't explain it. Sometimes these companies just, it's buy on rumor and sell on the news. News comes out, you scratch your head. You're like, what's wrong with this news? And yet the stock was at 168, went down to like 146 intraday. It was down $22. And so this was a chart I provided to members, and it basically came off that upcoming earnings chart list. I saw it was down, and then I looked at the AD on it, which was off the charts. And what this AD tells us is that stocks tend to close in the upper half of their trading range. That's how you get a strong AD line. And so when you see some of these stocks down a lot, especially one that just reported what I thought was pretty good earnings, this was a candidate I thought we could get a big reversal on, and we did. We came all the way back up, held the 20-day, printed a hammer, and look at what happened the next 3 days. So from 148, which is where it was when I sent the email out, actually, I think it had already gained another $2 or $3 before I even got the email sent, because I was working on other areas of the report. So I think it was around 151 or 152 maybe by the time I sent it out. Anyhow, it closed that day around 156. 3 days later, it's 170, back above where it was before earnings. Those are the kinds of short-term market inefficiencies that we like to try to capitalize on when we can. They don't come along too often, but especially earnings season, we do see them, still quite a bit. So again, getting back, to software right now, maybe we're going to get some stocks that are looking decent, pull back, but we know that the next 3 months, especially August, but again in October, these are months where software tends to do pretty well. So as these earnings reports come out, look for the ones that report good results. And if they do pull back to a key, 20-day moving average or price support, or maybe even put a tail in just below key support and then start to come back up again, might not be a bad time to jump into some of these. So software overall, I think things are turning. Here we are going into August. July, I said eight out of the last 10 years, July's been higher. Well, there you go. I mean, we started July, 4,250, ended it close to 4,600. I mean, was a pretty good run for software in July. Now that's the absolute price action, but I think it looks really good on the chart. We've already taken out that June high. This is what I'm thinking maybe we get on the overall market, just a slightly higher high and then maybe a little pullback. But watch this price support area right here. Triple top breakout. We got the 20-day moving average coming up from underneath. The PPO now has turned positive. When that happens, I look for rising 20-day tests as support until it proves me wrong. Now look back here in March and April. I remember back then, I even talked about, hey, this wasn't the bottom because we didn't see those rotational changes at this bottom. Everything was still pointing lower. So the rally, in my opinion, wasn't going to last, and it didn't. But here, I mean, if you'd done the same thing, okay, PPO going up, we're above the 20. I need to wait until we have break below the 20. Well, When I broke below the 20, that would have been a sign that, hey, this is not an uptrend, probably not an uptrend. And sure enough, we kept going lower. So that's what I'm going to be watching here on software to the downside. All right. Talk about earnings for a couple minutes here. Number of companies out after the bell last night, before the bell this morning. One of the more prominent names, Advanced Micro Devices, AMD. I'll tell you what, I'll pull these up in real time so you can see how they're doing this morning pre-market. Advanced Micro down 4.3%. They beat 56 cents versus 41 cents. I just looked at bottom lines on these. I have not looked at revenues. Some of them I may have seen the revenue kind of, but basically I was just looking at bottom lines. Most of these companies beat, by the way, that I looked at last night. So the earnings haven't been bad. It's just the spin that the market puts on them sometimes. Anyway, AMD down 4.3%. How about Airbnb? Not a great report there. They did beat on the bottom line. I think the problem with, AMD, I gave you the wrong numbers. AMD was $1.05 versus $1.03 on the bottom line earnings per share. So a slight beat there. Airbnb was 56 cents versus 41 cents. And they reported that the bookings for the upcoming quarter were lighter than expected. And so Airbnb taking a hit, down 6%. PayPal, are we turning the corner? PayPal up 13% this morning after reporting better than expected results. 93 cents versus 85 cents. So a nice little pop on PayPal. 101, that's going to open up in here. You can see prior support, which then became resistance, was around 95. So this looks like we're going to have a pretty good pop above resistance. I would say the bottom's now in on PayPal. Whether or not it goes straight up and is a great performer from here, I don't know. I'd like to see how it performs after the opening bell, because you're going to have a lot of market makers on the short side because everybody's jumping in with this gap up on the long side. So if market makers get control of it, we could see a gap fill right back down to 90. If market makers can't, and everybody's piling in, then we'll see a hollow candle from wherever we open and we'll continue moving higher. To me, that would be a much, much more bullish candle for the longer term. Starbucks reported. Starbucks 84 cents versus 77, up 2.6%. Occidental Petroleum in the oil patch, up only 10 cents. 316 versus 293, a very nice earnings report. At least bottom line was good. Stock really not seeing much, and that makes me worried a little bit about energy. Just because energy went up so much, I'm wondering if some of this good news that we're seeing with earnings is already priced in. Match Group, not good. The group down today 21%. They did beat on the bottom line, 89 cents versus 69. I think their guidance was light from what I recall. And also the CEO of Tinder has said he's leaving. So those are a couple of things holding back the stock, I would think. PAYC, this is a really solid software company. I would have expected good numbers here. This is one software company I think that was starting to show some decent relative strength. You can see down here, nice absolute strength as well. Stock gapping up $6 this morning, so that's good. One disappointment, of course, the stock had made a big run heading into earnings, but one disappointment last night was SolarEdge in the renewable energy space. Now, Zacks is showing that it missed 95 cents versus $1.40, but I had seen another article that said that they had beat bottom line and missed revenues. So I'm not quite sure. I got to do a little bit more research on that one. But anyway, traders didn't like it, down 10%. Now, of course, it had this big run. Remember, Enphase Energy came out with huge numbers about a week ago and took off. And I think in sympathy, SolarEdge ran up with it. Well, now today it's giving most of those gains back, coming back down. But still, the overall group's been pretty solid of late. SCI, another company reporting last night. This is one of our portfolio stocks, down 1.6% today. They did beat 84 cents versus 82, but you can see we've had a really nice run on Service Corp breaking out. I think you're going to have some really nice support if you get down here around 71, 72. And again, pre-market 72.49. Robinhood reported last night. Stock is up 1.7%. They lost 34 cents per share, but that was better than the loss of 36 cents that was expected. This morning, a couple more that came out, pretty big ones. We had CVS reporting 240 versus 216. So a nice beat there. And the market just opened. You can see that open right there, 98. So that's up 2.8%. Last one, mRNA, Moderna. And let's go ahead and take a look at that on the chart. They did beat 524 versus 450. And the stock is up $7.60 or 4.7%, almost 4.8%. So those were all the earnings. Let's see. What do we, for the three you must see? I'll tell you what, let's just look at a couple of software stocks. We talked a lot about software. Microsoft, I love Microsoft here. Big move up, breaking out, has pulled back just slightly. If we pull this up on a relative basis, one thing you'll notice, Microsoft has been trending higher relative to software most of this year. So if you're looking at the absolute chart, you're watching Microsoft go down, but that's only half the picture. Microsoft going down, but it's outperforming its software peers. And the AD line just set a new high. So yeah, we're way off the highs, but there's been plenty of buyers. And I'm going to say it's been Wall Street while everybody else wants to sell all year long. They've been buying. And I have a feeling it's because it won't be too long. We're going to see Microsoft back up here at 340, 350, challenging all-time highs. Now, in the short term, watch the rising 20-day. That's down around 268, 267. So if we continue to hold that 20-day, I expect to see continually rising prices here on Microsoft. Cadence Designs, one I talked about recently, last couple of weeks, really like this one. Got up close to resistance. AD line, again, very, very strong. Look at the relative strength versus software. It's been exploding. Big, big volume with its earnings to go higher. It's pulling back, but with this AD line, don't be surprised to see CDNS make a reversal at some point today. I wouldn't be surprised. Haven't seen a whole lot of big red candles for the last 6 weeks, maybe 2 or 3. For the most part, when you're down in the morning, you rally back. So we'll see what happens with CDNS. And then let's see, last one. Who else do we want to look at? Oh, AYX. That was one that reported last night. Had a really good report, or at least a great reaction. AD line starting to pick back up again. It looks like we're breaking out of this. This looks like a breakaway gap where we're kind of breaking away from this downtrend, starting a new, potentially new uptrend. Let's see how we finish today. We don't want to see a big black candle where we, close way off the highs and way off the open. What we'd rather see is a big hollow candle where we close above the open, showing that there's tremendous demand. Anyhow, that's it for me. Let's get a quick look at what's going on here. We're 3 minutes into the market. We got the Dow up 159. We got the S&P up 24, NASDAQ up 113. So we are back on the positive track again. Dow Jones, let's see, Nike leading. Talked about footwear. Footwear is definitely improving. Nike leading the way there. S&P 500, PayPal leading at 12%, Moderna 6%. NLOK, that's another one that reported earnings. Regeneron Pharma, those are your 4 winners. CVS right behind them there. A lot of these are earnings related. The decliners, you can see Match, Sedge, down 63, down to 301.97. That's a big. Let's take a look at this. We'll wrap this one up. Yeah, this is an area now. This one's got really strong AD line, and it's down a lot from the open. This could be a 20-day test. This looks a little bit to me like MedPath. Maybe this one gone up a little bit more and was down a little bit more because of it. But this is the kind of candle. We've gone down, tested gap support. Now it's early. Maybe we go down even a little bit further, but building a little position might not be a bad idea for those of you that are willing to take some additional risk. This is definitely a high risk trade. Anyway, that's it for me. Listen, everybody have a great day. I'll be back tomorrow over at Stock Charts TV, where you can click on this tomorrow morning at 9 a.m. Listen to the next episode of Trading Places Live. Take care, everybody. Happy trading.